Hello everybody, welcome to JAIIB CAIIB English Medium channel. I hope that all of you are doing fine. And after the registrations have closed, you are pretty much serious in your preparation. Whatever preparation level you are at right now, it does not matter as such until and unless you are consistent till the last minute of your exam preparation, you will sail through. Have certain confidence in yourself, and that particular confidence as well as the consistency will sail you through this examination. Today, in this Hero to Superhero series, we will be talking about the Indian economy and Indian financial system. Although we have covered various topics in the past also, pertaining to the IFS, and many students have asked the doubts again. I would like to tell you that whatever question you have, do comment in the chat section, because only then the session which you are attending, you will reap the benefit out of that. Otherwise, what will happen? It is just a one-way communication where we are delivering the lectures and you are just listening to whatever is taught in the class. Fine. So that is the message from our side, that you must be consistent enough in your preparation. Plus, if you are attending this session, do ask your doubts as well. Fine. So let's start the class 7th of Indian economy and Indian financial system. We will cover one important concept today. Along with that, one question based on that particular topic as well. Yes, only one question, but that question will test you like anything. So when we talk about the union budget, that is the topic which is there as a chapter only. So unit 19th under your IFS in module B. Although it's the last unit of module B, but it is highly important when it comes to the formula based questions. IIFS has limited amount of formula based questions, but in union budget, from union budget, you will find one or two questions in the examination on a regular basis. So when we talk about union budget for our examination as such, what is important? It is important to cram various components which are there in the revenue account, or for that matter in the capital account, or you can say the revenue receipt or the capital receipt. Same for the capital expenditure and revenue expenditure. But if we do not understand what is going on in the union budget, how the things will be distributed among these components, then it won't be serving the purpose of reading this particular topic. So let's start our discussion with the understanding part. So budget in itself is like a wallet. Fine. Let's just try to make an analogy where we are saying that budget is just like our wallet. The union budget, all everybody knows that it is, you can say, the treasury of your government of India, or for that matter, state budget is there for the state governments. But let's try to make an analogy that we have a wallet where we have certain amount of funds. Fine. We use these funds for either spending, fine, spending for our day-to-day activities, or for that matter, we also use them for investment. And from where these funds are being earned by us, these you can say transactions which are being earned by us, they are in the form of credit, be it in the form of your salary, the monthly salary, or for that matter the interest payments which you have earned thanks to the FD, or for that matter you have certain transactions going on from your relatives family to your account. Fine. So credit will be there, or there will be certain spending. That is the core function for which we use our money, and this money belongs to a wallet. Now let's just add something here. When we talk about money, the money can be kept in various accounts, various saving bank accounts will be there. So let's suppose you have one account in HDFC Bank, you have one account in SBI Bank, you have one account in Union Bank of India. So all these accounts will be having one thing common, that the funds will either be credited or the funds will either be debited. So like that, like this particular wallet only, which is utilized by us, Government of India also has a particular union budget where we have two types of accounts from which the transactions happen. So the types of accounts are revenue account and capital account. Just for the sake of simplicity, we have made the example, we have taken the example of wallet so that you can understand that how the union budget works. So union budget has two types of accounts. One is your revenue account, another one is the capital account. For all those transactions which are happening within 1 year. Fine. The time period is within 1 year. All those transactions will be to and from the revenue account. Okay. And if we are talking about the long term transactions, that is, the transactions are having the time period beyond 1 year, then the transactions which are to and from which account, they will be to and from the capital account. Okay. Capital itself means, in the parlance of finance also, we say that capital is a type of long term asset. And all those long term assets are known as what? Your capital only. And that is also one of the analogy which you can make while distinguishing between revenue and capital account, that the long term transactions will be a part of capital account, whether you are earning that particular amount or you are spending. Now, as soon as you know that there are two types of basic advantage of a particular wallet, that you will either be spending or some money will be credited to your account. Likewise, in the revenue account and capital account also, we have something which is known as revenue. Fine. Revenue is what? Your earning, whatever you are earning. Then we have the expenditure. The second component is expenditure. And what is this expenditure? That is your spending. Fine. So expenditure as well as revenue are the two core aspects of any account. When I talk about the revenue account, we have the revenue receipts, and for the revenue account, we have the revenue expenditure. Receipts will be all those funds which are being credited to the revenue account within 1 year. They will be termed as your revenue receipt. And the expenditure which has been done using this revenue account will be termed as the revenue expenditure. For our exam, what is more important beyond this conceptual understanding is that what are the components of revenue receipt? So maximum portion of government of India's earning is from taxes. Fine. Everybody knows that the government earns maximum funds from the taxes. And this taxation system is so robust that government of India has a dedicated component of receipt pertaining to the taxes itself. So tax receipt will be one of the component of revenue receipt, and the remaining portion from wherever you are earning, from wherever the government is earning apart from taxes, will be termed as non-tax receipts. So two components are there in under the revenue receipt: tax and non-tax receipts. Then we have capital account for the long-term transactions. They will be capital revenue for the money which you have earned, which the government is earning in a long term. Capital expenditure, the money which the government is spending, or the long term spending of the government, will happen from the capital expenditure part of the capital account. Now this capital revenue, like the revenue receipt, is also having two major components: one debt creating, another one is the non debt creating. What is this debt creating? So for a long term transaction, always remember, if there is a long term transaction, you will be either having it as your investment, fine. Either it is your investment, which is for the long term, or for that matter, it will be your obligation, fine. So if the obligation is there, a long term obligation is there which the government has to fulfill after, let's suppose, 3 or 5 years, then we will say that this type of funds which right now has been disbursed into your account, to the government's account, right now they are a part of what? Revenue, fine, because they have been credited to your account. But in long term, in the capital account, what will happen? You will be serving this debt. You will be having the obligation to repay this debt. So this type of transaction will be categorized into debt creating. And those against which we need not to pay any kind of debt, any kind of interest, any kind of obligation, they are known as non-debt creating. For example, when we talk about the debt creating, you will have uh, IMF. There is IMF, fine. So IMF is there to help the member countries, and India is also one of the member of India, your International Monetary Fund. So during COVID era, government of India focused on the funding from external sources, and IMF was also one of the source. So let's suppose IMF provided the funding to Government of India in 2020. Okay, and the funds which were disbursed were, let's suppose, 5 CR. Okay, so in 2020, these funds which have been credited by the IMF in the Government of India's account, that is the budget, they will be forming a part of revenue or expenditure in 2020. They will be treated as a revenue because the government has a credit to its account. Which type of credit will be it? Whether it is a long term credit or a short term credit. Fine. So it will be a long duration credit. Why? Because Government of India will be utilizing these funds in a stipulated time period, and after a certain time period, the Government of India will be serving this amount back to the IMF as well, because it is a type of loan. So although in 2020, I would say that it will form the part of capital revenue since it's a long term transaction. But let's suppose the repayment has to happen by 2026. So on a particular date in 2026, what will happen? This amount 5 CR along with the interest payment will be provided by the Government of India to the IMF. Fine. So in 2020, although this amount has been credited in your capital revenue, but it has created what? A debt which you need to serve by 2026 with the particular interest payment. Okay. On the contrary, if the government has provided a certain type of investment for the particular ministry, let's suppose Ministry of Finance has invested somewhere in the financial market back in 2020, and today in 2025 the same funds with whatever they have invested, the particular instrument has matured and the funds will be redirected towards the Government of India, or for that matter Ministry of Finance's budget. So they will form part of what? The Indian budget, union budget only. And in union budget they will be credited in which account? Long term account, because it was an investment. So capital account they will be credited. Under capital account, which component? Capital revenue or capital expenditure? Under capital revenue. And within this capital revenue, whether it will be a debt creating or non debt creating against the funds which you have earned after your investment, you are not supposed to pay any kind of interest in future, so they will be non debt creating funds. Fine. So I hope that all of you are able to understand that how the mechanism of the budget works. We have revenue account, capital account, revenue account for short term transactions, capital account for long term transactions. Then we have revenue receipt and revenue expenditure under the revenue account. Revenue receipt is of two types. You have tax receipt and non tax receipt. Capital account has capital revenue, under which we have the two categories: debt creating and non debt creating. Debt creating, against which the government has to repay certain type of interest as well as the principal amount. Non debt creating, no need to serve any kind of loan. When I talk about the capital account, it also has the expenditure part which is known as the capital expenditure. Now let's see a particular formula for the revenue deficit. The revenue deficit is nothing but the difference between the expenditure, revenue expenditure, and the revenue receipt. So it will be concerning only one component, that is the revenue account of the budget. Normally, we have seen just now, budget has two components, revenue account and capital account. But here, what is happening? We are calculating only the difference between revenue expenditure and revenue receipt. So we are arriving at the revenue deficit. Do you think that only calculating the deficit from the revenue account will suffice for the exact or the accurate calculation for your deficit in the country? Answer is no. It must take consideration into the capital account as well. So capital account as well as the revenue account, both combined together, will give a holistic picture regarding the deficit in our country. That is why right now when we talk about in 2025, revenue deficit is no longer applicable in Indian conditions. So although the formula is simple, total revenue minus total revenue expenditure, but when we talk about the applicability of revenue deficit, it is no longer applicable on the Indian, you can say, conditions. When I talk about the fiscal deficit, this is a holistic one. This is a more comprehensive way to define the define the deficit of the government. So it is the excess of government spending over its earnings. And when we talk about the difference will be between what? The total expenditure. Total expenditure includes what? Revenue expenditure plus your capital expenditure. So total expenditure is revenue expenditure plus capital expenditure. That will be subtracted by revenue receipts plus your capital revenue. Fine. So total expenditure minus total revenue. But one more aspect is there which we must remember. Fiscal deficit will be equal to the total expenditure minus total revenue, and from this total revenue you have to exclude the borrowings. Okay, always remember this thing. Students often miss this part, but it is very important to know that you have to subtract the borrowings because they are not a part of your revenue. Long term revenue, it is not a part of the borrowings are not a part of your long term revenue, which will reflect the entire deficit. So that is why you will be subtracting the borrowing before you calculate the fiscal deficit. So step one will be what? Subtract any kind of borrowing from the revenue and then subtract it from the total expenditure. Next we have ERD, that is effective revenue deficit. What is the formula for effective revenue deficit? Just the revenue deficit minus the grants. Fine. This is the formula for your revenue effective revenue deficit. Whether IIBF can ask this question or not? Yes, IIBF can ask it, because as a concept, although it is not right now present in our country, but as a concept, it is still there in the books. Then we have primary deficit, the more important formula, that is primary deficit. It will be what? It is equal to the fiscal deficit minus the interest payments. Whatever interest payments have been done, have been served, they will be subtracted from the fiscal deficit and it will be the primary deficit. That yes, you are having an obligation, the country is having an obligation to repay the debt which has been created towards, let's suppose, IMF or any other international organization. That is the separate obligation. You will be paying the interest amount there. So whether you have to include it while calculating the primary deficit, answer is no, because you are already serving it via the mechanism of debt. So you will be subtracting the interest payments from the fiscal deficit and you will arrive at the primary deficit. Okay. So fiscal deficit reflects the actual amount of, you can say, deficit which is there pertaining to the fiscal policy. Fine. Fiscal policy, which is a policy to maintain the economic conditions in the country, and government of India has the most important tool to regulate this fiscal policy in the form of union budget. Okay. Now after this we have various components, like receipts have various components, but today we will be looking into one component only, that is the capital receipt, and that too only the receipt part, non-debt and debt receipts. So when I talk about the capital receipts, the long-term receipts which are there, so non-debt creating receipts will be what? Recoveries of loans and advances, whatever you have recovered, so it is not a loan anymore. Disinvestment receipt, whatever the private players have paid the government, or the amount of money which the government has earned after selling off its shares to a private company, fine, against which you need not to serve any kind of loan or the interest payment. So whether you are recovering a loan or advance or it is a disinvestment receipt, it will be yours only, the government's only, on which no debt has been created. So non-debt receipt. Another category in the capital receipt is debt receipts, which are market borrowings, whatever you are borrowing from the market, be it the GSEC or for that matter treasury bills. Then we have the securities against small savings as well. They are also part of your debt receipt. Then the state provident fund, other receipts like internal debt and public account, as well as the external debt. All these clubbed together will be termed as your debt receipt. And when I talk about the capital receipt in total, what will be the formula? It will be the addition of these non-debt receipt plus the debt receipt. And for the sake of simplicity, let's try to understand the total receipt as well. So total receipt will be what? The entire receipts, whether it is from the revenue account or capital account. So it will be total revenue receipt plus the capital receipt plus your drawdown of cash balance, known as DCB. What is this DCB? So whenever a budget is being presented in the parliament, do you think that at that moment the government will be having 0 rupees in its kitty? Answer is no. There must be some balance from the previous financial as well. And if you are not utilizing that balance right now, it will be included in the budget of the upcoming financial year, which is known as drawdown of cash balance, which will be a part of your total revenue. Okay, so total revenue will be the total you can total receipt will be total revenue receipt plus capital receipt plus DCB. Fine. Next, let's try to solve one question based on this only. State government's financial report has been given here, where revenue receipt, capital receipt, and total receipt is provided to you. You have to calculate the DCB, drawdown of cash balance. So just now we have seen the formula, which states that your total receipt will be equal to, so here it is what, 75,000, fine. This is the total receipt. This will be equal to what? Capital receipt plus revenue receipt. So 50,000 plus 20,000 will be what? 70,000 plus drawdown of cash balance. Drawdown of cash balance. This has to be answered in the question. So DCB will be what? 75,000 minus 70,000. Answer will be 5,000 CR. Okay. So I hope that such kind of questions, if asked in the actual exam, will be able to answer them correctly. Okay. So this was it for today's class. If you have any kind of doubt, do let me know in the comment section. And for the PDF of this session, you can directly scan this particular code, and you will be redirected to the virtual library. Keep on studying, keep on revising. We'll meet in the next session. Till then, goodbye, everybody. Take care.